Last week, the Federal Reserve announced it is raising interest rates by 0.75% in an effort to fight back inflation. That's the third time they've raised rates just this year, and this is the single biggest raise since 1994. So why does the Fed raise or lower rates? Well, they do it to try to balance out the economy. Traditionally, rates are a lot higher than they are right now. Back in 1980, the Fed jacked up rates to almost 20% as a way to fight inflation. Then they typically drop them right after that through recessions, the shaded areas here on our graph, as a way to stimulate the economy, encouraging businesses to borrow money and build things. They went from nearly 4% in 2008 to almost zero in 2009. It stayed that way for quite some time. Then it happened again in March of 2020 when the pandemic hit, going up from about 2.5% to almost zero. And that's good for business, but the rates can't stay there forever, because if the economy falters when rates are still low, there's nothing else the Fed can do to help. And it also runs the risk of inflation when they're low, like there is now. Now, one drawback to rising rates so quickly is it leads to higher rates for things like mortgages. Now, if you have a mortgage, it doesn't matter much. But if you're looking to buy a house, a $250,000 mortgage, 30-year mortgage, will cost you about $300 per month more than it would have just a couple months ago. And it's about $500 per month more than if you got in and rates really bottomed out right at the beginning of this year. That's it for